here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing in finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. In this episode of Value Investing in Your Car, I want to talk about relative valuations. Before we get to that though, I want to say that you can get this series as a podcast on all major podcasting platforms now for free anywhere in the world. Anchor, Spotify, Stitcher, SoundCloud, iTunes, and all the major podcasting platforms. You can get this content as audio for free anywhere in the world, so you can listen to great value investing content anywhere in the world, again, for free on all major podcasting platforms. Okay, so today I want to talk about relative valuations. The other day I got a question on the website about somebody asking if you can compare within an industry, if you can compare, say, PE ratios or PE multiples to see if a company is undervalued, overvalued, fairly valued compared to the rest of its industry. My answer was yes, you can, of course, but PE ratio is terrible. Earnings per share is terrible, net income is terrible. And again, if you've not seen any of my blog posts on this or video content on this, they should be linked below. I talk about this at length. I have two different posts about why I have a blog post about why I never use net income. I think that might be in this series, actually, the Investing in Your Car series. And then I have two other posts about, one is definitely in this series, why PE is terrible and how to calculate EV, and also the blog post that I wrote a couple years ago, why PE is terrible and how to calculate EV. Those three posts should give you a great idea of why I do not use net income, PE, earnings per share, and anything. I do. So check those out on the blog. Again, they should be linked below this. So I'm not going to talk about that today because I've talked about that at length. So I want to talk about relative valuations today. What I told this person is, yes, you can do stuff like that. But what I would do is use EV to EBIT, EV to free cash flow, EV to owner's earnings, or TEV to EBIT, TEV to free cash flow, TEV to owner's earnings. You can use those numbers, again, barring insurance companies, barring things like financial stocks. You can use those metrics to compare to not only other companies in the same industry, but in my opinion, other companies that you either own or are looking to buy as well for your portfolios that you manage. For years, probably 5+ years now, I've saved every single analysis report I've ever written, every company I've ever done even a little bit of research on, in terms of these metrics at least. I've saved information on ROIC and these kind of metrics. Again, EV to EBIT, TEV to EBIT, EV to free cash flow, TEV to free cash flow, EV to owner's earnings, and TEV to owner's earnings. I've saved ROIC information and these relative valuation information on every company I've ever looked at before that I've done these calculations for again, probably the past 5 years. So I can go back and compare and contrast. Is this company more undervalued? Is this company undervalued compared to this one? Is it overvalued compared to this one? Is it about fairly valued compared to this one at those specific point in times as I was making the analysis? Now, if you're doing that, let's say today, and you have a company you researched years ago, you'd have to compare that based on not only that time frame, but today's time frame as well. Because you're not buying the company years ago. If you're looking at a new company, you're buying it now. But you just want to see kind of what it's done over time as well. That's another way you can use it. What has it done over time? Has it become more profitable over time? Has it become more undervalued under time? Has it become undervalued over time? Has it become less profitable? Has it kind of just stayed stagnant? What has its competitors done in relation to that? Has their multiples gone down because they become more profitable or less profitable, etc.? A lot of people don't like relative valuations, and I don't usually either when it comes to things like PE. I don't even like price to book that much, unless you're looking at something like an insurance company, or you're just looking for something that is selling below book value, because in my opinion, price to book value doesn't really tell you as much as things like EV to EBIT does. For example, price to book value tells you the share price, or the share price divided by the book value, net book value of the company. If it's over 1, it means the company is overvalued compared to its book value. If it's undervalued, or if it's below 1, it means the company is undervalued based on its book value. But again, that just considers the book value of the company, which is essentially the balance sheet. It doesn't talk about operating profit at all, or the operation side of the company, which is what EV to EBIT shows. EV to EBIT, EV shows the enterprise value of the entire company, considering the market cap, debt, and cash, and other things like minority interests, preferred shares, but most companies don't have those anymore, unless they're huge companies, which for the most part I don't look at. So EBIT is operating income. So you're comparing profitability, the overall kind of size of the company based on today's market price, or at that point in time's market price, whenever you're looking, compared to its profitability at that point in time. So you can tell not only is it profitable, you can tell how that those numbers compare to each other. If profitability rises, but the share price doesn't, the company becomes more undervalued. If profitability lowers and share price doesn't, the company becomes more overvalued. If earnings or if net income rises about in line with the size of the company stays about fairly valued over time. And the inverses of these are all true as well. So you can tell a lot about a company with these kind of metrics. And another reason I don't like price to book, going back to that, I thought about this as I was talking about EV to EBIT, is price is only the price based on the market cap. It doesn't include cash or debt. That's the reason I don't like. It does because it has the book value, but that's why I don't use PE, is because it doesn't include cash and debt. Or one of the reasons. There's several reasons I don't use a PE, but that's one of the main ones. And almost every company on earth has some form of debt or cash. So, but yes, I use relative valuations to compare, again, not only companies in the same industry, but also companies I own stock in and have for years, or also I'm thinking about buying. I use those numbers to compare to other entities. I do the same thing with ROIC and these other metrics that I teach in our masterclass as well. That I use these metrics, again, barring these don't work generally on financial companies and insurance companies, these kind of things. But barring that being one of those kind of companies, these metrics work. In my opinion, you can compare and contrast these kind of companies with each other, even in different industries. So I hope this helped. I hope this helps the person. I didn't get the name. They didn't leave their name. So I hope this helps. If you're watching, that person who asked that question the other day, hope my other sources I sent you helped. Again, those videos should be linked below about the net income, why I don't use that net income, and why I hate PE, or why the PE is useless, and how to calculate EV, I think is what the blog post is called. So those should be linked below. Make sure to like, love, share. If you're watching this on YouTube, subscribe and hit the notification bell so you're notified anytime we release a new video. And we're over 560 videos as of this recording. And releasing new videos all the time. If you're listening on the podcast, make sure to listen on the podcast, or make sure to listen on the podcast. If you're listening on the podcast, make sure to like, love, share as well. And make sure to comment. If you're watching on the blog or YouTube, I reply to, or social media, and I reply to all comments myself. Hope you found some value in this. Hope you learned something. Thanks a lot. Have a good day. I'll talk to you again soon. Bye.